My name is Michael Grandy. I'm a professor at Providence College, and this semester I'm teaching a course in the MBA program, MBA 603, and this is essentially a graduate version of managerial accounting. Um, we're talking about Chapter 13. We're talking about differential analysis, and I want to go over three problems in today's class, and specifically, we're looking at the first exercise is exercise 13-2. And if you remember, the topics that we're talking about here in differential analysis are decisions. And the decisions are, the first one, should we keep or drop what appears to be an unprofitable product line or division of a company? Secondly, we're looking at questions of whether or not we should continue to make or buy a component of our product. And the third decision we're looking at is whether or not we should accept or reject a special order. And all of these questions revolve around relevant information. What is relevant to our decision? And oftentimes what we're going to find is the revenue is always relevant, and the variable costs are also relevant. More importantly, the contribution margin is what we want to focus in on. And all of the solutions that we look at, I generally focus in on contribution margin because we know that revenues and variable costs go together. Because the only reason, if we have the revenue, we have to have the variable cost. By definition, total variable cost is a function of quantity and price. How many units do we make, and what is the variable cost per unit? If we don't make any units, we don't have any variable cost. But fixed costs are a big issue here because the question is, do fixed costs continue to stay in the business or do they get out of the business? And the general rule is that fixed costs are not avoidable. What that means is that fixed costs stay in our business because by definition, total fixed costs do not change with volume. So whether it's 10,000 units or 0 units, we still have that fixed cost. But there are some fixed costs that can be avoided. And as you're looking at these problems, you need to look very carefully to see if they do go away or if they do stay in the business. So let's first take a look at exercise 13-2. And this is in your textbook, obviously, but I want to read it and highlight some of the things that are important. And it says here that Regal Cycle Company manufactures 3 types of bicycles: a dirt bike, a mountain bike, and a racing bike. Data on sales and expenses for the past quarter follow. And what you can see here very easily is that you, number one, are provided with a contribution format income statement, which you're very familiar with. And you're seeing 3 divisions. You're seeing the 3 product lines: the dirt bikes, mountain bikes, and racing bikes. And you can clearly see that 2 of those divisions, the dirt bikes and the mountain bikes, are profitable. They have positive net operating income. But the racing bikes is losing money. They have a loss of $9,000. It goes on to say, management is concerned about the continued losses shown in the racing bikes and wants a recommendation as to whether or not the line should be discontinued. The special equipment used to produce racing bikes has no resale value and does not wear out. So the question is, should production and sale of the racing bikes be discontinued? So I always ask the question, what goes away? What, if you were to eliminate the racing bikes, what goes away? And it's pretty clear that if you eliminate the racing bikes, the sales revenue is gone, and also the variable costs are gone. So in other words, you're losing the contribution margin. And then is a question of all those fixed expenses. The first one is advertising, and the label there is it's traceable. And what that means, traceable, means that the only reason they have that advertising expense is because of the racing bikes. So the assumption here with the word traceable is saying that if you eliminate the racing bikes division, then the advertising would also go away. It goes on to say salaries of product line managers. Now, this sounds like it is specific to this product line. And it sounds as if, because it says product line, it means that if you were to eliminate the racing bikes division, then the supervisor's salaries would also be eliminated. And the third item we have here is called allocated common fixed expenses. And the asterisk says that these are allocated on the basis of sales dollars. Now, what's important to understand here is that allocated costs do not go away. Common costs do not go away. If you eliminate a division, those allocated costs simply get reallocated to the remaining divisions in the business. So when we're talking about keep or drop, I ask us to look at the contribution margin versus the avoidable expenses, the avoidable fixed expenses. And I ask the question, what goes away? Now, the rule is that if the contribution margin given up is greater than the avoidable expenses, your conclusion should be to keep the division. But if the contribution margin given up is less than the avoidable expenses, then you want to drop that division or product line. So let's see what's going on here with regard to the racing division. So the contribution margin given up is $27,000. What about the avoidable expenses? Well, the advertising is $6,000 of advertising expenses. That's traceable. That's going to go away. And the salaries of product line managers, that's 10. That's going to go away because it's product line. So that would go away if you eliminate the division. But what about the allocated common cost? No, they don't go away. They simply get reallocated to the dirt bikes and the mountain bikes. So you've got $27,000 of contribution margin that's given up, and only $6,000 of $16,000. You got $16,000 of avoidable expenses. So because the contribution margin given up is greater than the avoidable expenses, your conclusion is going to be to keep that division, okay? Because that's $16,000. Okay, let's look at another problem. And the problem I want to look at here is going to be a make or buy decision. This is exercise 13-10. And this is make or buy, and let's read it. It says here, Futura Company purchases the 40,000 starters that is it installs in its standard line of farm tractors from a supplier for the price of $8.40 per unit. Due to a reduction in output, the company now has idle capacity that could be used to produce the starters rather than buying them from an outside supplier. However, the company's chief engineer is opposed to making the starters because the production cost per unit is $9.20, as shown below. So you see units here, you see direct materials cost, direct labor cost, supervision, depreciation, variable manufacturing overhead, and rent. And they've come up with a cost per unit of $9.20. It goes on to say, if Futura decides to make the starters, the supervisor would have to be hired at a salary of $60,000 to oversee the production. However, the company has sufficient idle tools and machinery such that no new equipment would have to be purchased. The rent charge above is based on space utilized in the plant. The total rent of the plant is $80,000 per period. Depreciation is due to obsolescence rather than wear and tear. And the question is, what is the financial advantage or disadvantage of making the 40,000 starters instead of buying them from an outside supplier. So the question is, what's relevant and what's not relevant? So I like to look at this from a make or buy analysis. So let's take a look at the costs that are relevant. Well, if they make it, and only if they make it, do they incur the direct materials cost of $3.10. It can be avoided by buying it. The direct labor, they only incur that cost if and only if they make it. If they buy it, they don't have to pay it. They have the variable manufacturing overhead, which they said the variable manufacturing overhead was 60 cents. It's variable. They would only incur it if they make it. The supervision, what does it say? It says here that the supervision is specifically what? It says supervision. If Futura decides to make the starters, a supervisor would have to be hired at a salary of $60,000. So you say $60,000 or $1.50, right? So that's relevant if they have that. And then what about the other two items that are on the list, okay? You've got depreciation. And I'll tell you right now, depreciation is a sunk cost. Depreciation relates to an asset that was purchased years ago and is simply being allocated over the useful life of the asset. So depreciation is not relevant. We ignore it. And then lastly, what about the rent? Well, the rent is an allocated cost. That rent is going to be there whether or not they make it or buy it. So it's irrelevant. So we ignore that one as well because it's irrelevant. And then the other cost that we need to concern about is the purchase price. So if you purchase it, they said the purchase price was going to be $8.40. So what do we have for costs? We have $7.90 if we make it. We have $8.40 if we buy it. So right now, there is a differential of 50 cents. That is the savings. And they want to purchase 40,000 of these things. So the financial advantage by making them is $20,000. So the recommendation here is to make them because it saves the company 50 cents a unit, 40,000 units, or $20,000. That's the make or buy. And the last problem I'd like to talk about is a special order. This is exercise 13-9, and this is a special order. And again, the question is whether they should accept or reject a special order. And the focus here needs to be on incremental revenue and incremental expenses. What comes into the company? What is the benefit to the company just because they accept the special order? Now, remember, we're only concerned about those things that occurred just because we decide to go forward with the special order. So let's read it. Delta Company produces a single product. The cost of producing and selling a single unit of this product at the company's normal capacity level of 60,000 units per year is as follows. Direct materials, direct labor, variable manufacturing overhead, fixed manufacturing overhead, variable selling, and fixed selling. So they distinguish between variable and fixed. And as you know, the only reason you will incur a variable expense is if you make the product. And oftentimes the fixed costs are in the business whether or not they make it. It's there, period. So what does it say? The normal selling price is $21 per unit. The company's capacity is 75,000 units per year. An order has been received from a mail order house for 15,000 units at a special price of $14 per unit. The order would not affect regular sales in the company or the company's total fixed cost. So it doesn't affect the company's total fixed cost. That means it doesn't change. The fixed costs are going to stay the same. First question: what is the financial advantage of accepting the special order? So can they make any money with this? And what we want to look at is the net operating income, or the incremental net operating income. So we're going to start by calling this incremental revenue. So we have incremental revenue. The revenue that we have only because we make it. So that's going to be $14 per unit, or $210,000, right? Because they're making 15,000 units. $14 a unit, 15,000. $14 a unit, 15,000 units is $210,000 of revenue. But what about incremental costs? These are the costs that we have only because we accept the special order. These are the costs that we only have because we decide to make the product. Clearly, direct materials at $5.10 for $76,500. Direct labor, again, assumed to be a strictly variable cost. That's going to be $3.80, or a total of $57,000. The variable manufacturing overhead is $1 for $15,000. And the variable selling, they said that was $1.50 for $22,500. Those costs they have only because they accept the order, only because they decide to make the product. We need to ignore the fixed cost, because the fixed costs are there whether or not they accept the special order. Remember, incremental, what's the change? Fixed costs don't change. Fixed costs are going to stay the same, so we ignore them. So we have a cost per unit of $11.40, or $171,000. We have incremental net operating income of $2.60 per unit, or $39,000. Because you have a positive incremental net operating income, you will accept the order. And generally speaking, whenever it's positive, you would accept the order. So what's the next question here? Goes on to say, as a separate matter from the special order, assume the company's inventory includes 1,000 units of this product that were produced last year and that are inferior to the current model. The units must be sold through regular channels at reduced prices. The company does not expect the selling of these interior units to have any effect on the sales of the current model. What unit cost is relevant for establishing a minimum selling price for the inferior units? So the answer says here, the relevant cost is $1.50, the variable selling expenses. All variable costs are sunk because the units have already been produced. The fixed costs are not relevant because they will not change in total as a consequence of the price charged for the leftovers. So the only item here that's relevant is the $1.50 of selling expenses, because all these other costs, direct materials, direct labor, and variable manufacturing overhead, have already been incurred. This $1.50 has not been incurred yet until they sell it. So that's what is relevant. So those are three problems that we looked at. Keep or drop, make or buy, accept or reject a special order. We'll look at some other problems during our synchronous class, but I wanted to at least go through these. Thank you.